We set this up as the growth trade is back, and it is in December. Growth is leading value. And just when I say that, I look at the notes, and it says Joe Terranova sold CRM. You sold Salesforce. Why, Joe?
I did. Well, Scott, I had to sell Salesforce to raise some capital to buy some other names. I purchased Sensata Technology. That's an EV play. I bought CNX Resources. That's an energy play, and I bought Capital One. But back to Salesforce. This is not about Salesforce being a bad business. I believe in Salesforce. It screens very high on my quality momentum index. It's in it. This is about I made a bad purchase. I bought Salesforce too aggressively, too high. And I'm just paring back the holding. I'm sure over the course of time it'll move forward from where it is here. But I needed to raise some capital to get in some other names, Scott, that I think are going to work in the near term versus Salesforce.
Well, I just said that the growth trade's working over value. You've just sold some growth and moved into value. A believer in the energy trade and Cap 1, 2, some of the financials. Why play against the momentum run?
Oh, I don't think I'm playing against the momentum run in its entirety, but what I'm doing is I'm respecting the diversification that is needed in my equity holdings. And I think the market on Monday told us everything that we needed to know. There should have been a flight to safety. There was not. The VIX was at 32. It's now at 22. You're at the end of a quarter, Scott, in which you should be seeing a rebalancing out of equities into bonds for portfolios. You're not seeing that. So I'm respecting all of that. I'm realizing I still have DocuSign in the portfolio. I have my Apple. I have my Microsoft, my Lululemon, my Monster. I've got my established growth. I just wanted to increase a little bit of the exposure towards what I would define as quality.
Okay, so Kerry, let's take Joe's example and take it to the next layer for our conversation. Is it time to be a selective seller of some of these high-flying growth names? You write an op-ed today on CNBC.com. At some point, sky-high valuations will matter, just like they did for the dot-com busts. So how do you address that question? Time to be a selective seller of these names or not?
Yes, Scott, I think it is. We did a study of the market and looked at all of the companies over $10 billion in market cap that are selling for 10 times or more next 12 months revenue. There are 117 of those companies now. A year ago, it was in the 40s, and 2 years ago, it was 21. We have a little chart that Vinny put together, and you can see that as interest rates have come down, the likelihood of buyers, big buyers of names that sell at extremely high multiples has gone up. And we just think that this is a time to be careful about owning too much of a portfolio in names that have gotten extended. They're parabolic. I mean, if you look at the chart of a name like Snowflake or Trade Desk or MongoDB, these are interesting and very good companies. Most are based on cloud software, and they have a market, but it's not unlimited for all of them. And if we can't make a case that the company will grow into the type of valuation, then, we'd have to trim it back. We own Twilio, which we've owned all year. It's been a great stock. We've trimmed it back 3 times. It was a mistake, really, but we still own a big position. And we think that's the prudent thing to do. If 15% of the market cap of the entire U.S. market, all public equities, is in stocks that trade at these kind of levels, that's more than we would feel comfortable. So, yeah, I think it's time to do that, and perhaps the place to put some money is maybe in Apple or the type of name like CRM where, they've paused, they've come down. So we think that there's a good area of growth to invest in, and it should not be as heavily into the extremely high valued names that have been the spike of the market for the last couple of months.
Well, I mean, Doc, NASDAQ's been hitting new highs lately. I mean, lately for the last few days in a row. Is that the train you want to get off of now?
No, it's not, Scott. We all know, we anticipate that there will be some tougher days in the middle of January to the end of January. But I think that you stick with the reopening plays, all of which virtually are working today phenomenally well, along with tech. like I say, I think the first 3 weeks of next year are going to be great for those tech names, Scott. And I think that after probably by mid-February, those reopening names really start catching a lift again, similar to what they're getting today. So, whether it's the airlines or cruise lines or whatever it might be, Vegas, I think all of that starts working, but probably not at the very beginning of the new year, but certainly 30 and 60 days in, I think you want to be in those names.